Welcome to this explainer. I am so pumped you're tuning in today because we are diving straight into a genuinely fascinating corporate mystery. Normally, standard business logic tells us that when a company hits a rough patch, when those numbers start tanking, you immediately batten down the hatches. You slash your costs, you hit pause on expansion, and you just play it safe. It's a lot like sailing a ship into a massive storm. You drop the sails and you brace for impact. But what if a company does the exact opposite? What happens when a terrifying financial drop is met with a huge, aggressive push for even more capital? Well, let's get right into it, because Natco Pharma's current strategy is a masterclass in corporate audacity.
Okay, starting with Section 1, the Q1 revenue shock, a sudden drop.
So every great corporate drama has an inciting incident, right? And for this one, it starts right here with this number, 44%. And guys, this isn't just a minor blip or a slight market correction. When a major pharmaceutical player sees a 44% tumble in a single quarter, the alarm bells absolutely start ringing. It means nearly half of the revenue they expected to bring in simply vanished. For any investor, analyst, or even a casual observer looking at this, a drop this severe demands some immediate answers.
To put that percentage into hard numbers, their Q1 revenue tumbled down to just 735 crore rupees. Now sure, 735 crore still sounds like a ton of cash, but context is literally everything in business. The crucial takeaway here is understanding exactly where this leaves the company. They're suddenly operating with a significantly smaller pie than they're used to. At a moment exactly like this, you would fully expect the leadership team to announce sweeping austerity measures, but instead, they pull off a sudden, massive financial maneuver.
Moving on to Section 2. What is a QIP? Fast Track Capital. So a qualified institutional placement, or a QIP, is basically the corporate equivalent of an express lane to grab a massive amount of cash. Instead of dealing with the insanely lengthy, heavily regulated process of offering shares to the general public all over again, they just skip the line. They go straight to the heavy hitters, the institutional investors, like your big mutual funds or insurance companies. It's quick, it's highly efficient, and it lets a company build up a huge war chest without those crazy delays of a traditional public offering. Which brings us to Section 3, the 2,000 crore pivot. Aggressive offense. 2,000 crore rupees. That is the sheer size of the QIP they are planning. They aren't just raising a little bit of buffer cash to smooth over that 44% drop. No, they are raising an absolute mountain of capital. It's a huge, bold signal to the market. They're effectively shouting, "We aren't retreating, we are reloading." But it's the scale of this number that makes it so unbelievably fascinating when you look at the bigger picture. Just look at this comparison. It really highlights the paradox here. On the left side, you've got their current reality, a battered Q1 revenue of just 735 crore. And right next to it, their target QIP is a whopping 2,000 crore. They are literally aiming to raise nearly triple their current quarterly revenue in fresh, immediate capital. It's a phenomenal pivot. It means they have to go out and convince major institutional investors that despite the 735 crore reality today, that 2,000 crore future is totally worth betting on. So what on earth are they going to actually do with all that money? Let's look at Section 4, Buying Future Growth, the Master Plan. This 2,000 crore is a highly specific war chest, and it's meant to fuel targeted corporate acquisitions. Think about it. When your organic revenue, the money you make from just selling your normal day-to-day products, takes a 44% hit, you basically have two choices. You can either painstakingly rebuild it product by product over years, or you can go out and buy successful companies that already have cash rolling in. Natco is choosing the latter. They're planning to literally buy future growth to counter this current revenue slump. By acquiring other businesses, they can instantly bolt new products, new patents, and new revenue right onto their balance sheet. But listen, M&A in the pharma space is notoriously complex. It is fraught with super tricky patent transfers and massive integration hurdles. It can be a really fast way to mask a slump, sure, but only provided you buy the right companies at the exact right price. And that brings us to the ultimate million-dollar question. Is buying growth the ultimate cure for a revenue slump, or is it just a really, really costly Band-Aid? Look, if Natco Pharma's acquisitions actually succeed, this 2,000 crore pivot is going to be remembered as a genius, aggressive move that totally saved their momentum. But if the companies they buy fail to integrate, or if they just overpay, well, they've just layered massive new debt and complexity on top of an already fragile revenue base. It's a high-stakes gamble for sure, and it perfectly highlights exactly why reading between the lines of these financial headlines is absolutely crucial. Thank you so much for joining me for this explainer. Keep asking those tough questions, and I'll catch you next time.